Hello friends, in this video we will try to understand the concept of investment returns. Many people confuse the different types of returns that a mutual fund or a stock investment platform show on their portal. So in this video what we'll do, we'll try to understand the different types of return and also understand how it's calculated in Excel so that investor can calculate the return in the correct way. So the three different types of returns that we have is the absolute returns, the compounded annual growth rate, and the XIRR. So the absolute return, most investors would be familiar. It's nothing but your uh, current value minus the starting value divided by your starting value, which is nothing but your absolute return for your investment. So what is more tricky to calculate is the compounded annual growth rate and XIR. So in this video, I will cover into the details of CAGR and XIRR. So one thing to understand is that CAGR captures the annualized return of an investment. Let's understand through an example. In this example, assume that the investment was done on 31st October 2021 and the value of the investment was 100,000 US dollars. So after 2 years, as of end October, the current value of investment is around 120k US dollar. So number of years is two. So if I were to calculate the absolute return, it will simply be my current value of investment divided by my starting value minus one. Okay, so which comes around 20%. But if I calculate my compounded annual growth rate, which is the annualized return, it will be my ending value divided by my starting value to the power of 1 by number of years minus 1. So you see, so annualized return is 9.54%. So many people, when they log into the mutual fund portal app or their stock market trading app, they see absolute return 20%. They're very happy with the investments. But actually, what they should do is they should try to annualize the return so that they will understand, okay, that what is the actual annualized return from the investment. But however, the CAGR return is also not the most accurate returns that an investor should use. The key reason is it does not take into account the timing of the investment or withdrawal. Now this example that I've taken is a very simplistic example. It in the whole investment period, I have assumed that there are no withdrawals being made, and also there are no interim investment made during the uh, whole investment period. But practically what we typically see is that an investor can invest into a particular fund or stock during the investment period. So there can be multiple investment and withdrawal during the lifespan of the investment asset. So the correct way to calculate the internal rate of return is that it takes into account the timing of the cash flow. So in this example, let's say the investor does a monthly systematic investment plan, which is also called as dollar cost averaging. So let's say the first of every month, the investor invest around 1000 USD into the fund or stock, and then the investor invest for 10 months from Jan till October. Then let's say as of the start of November, investor sells the investment for $11,000. So if I have to calculate the XIRR in Excel, I can use a function called as XIRR. XIRR is nothing but your internal rate of return. Internal rate of return takes into account the timing of the cash flows. Also, it takes into account the investment or withdrawals that has happened during the starting period and the end period. So in this example, if you see, you just have to use the XLR function in Excel, then give the values of your cash flow, and then select the timing of your cash flow and hit enter. You see the XR is 22.69%. So all the systematic investment plan and the dollar cost averaging type of plan, the platform will typically show you XIRR. So XIRR is a more accurate return than the annualized returns. That's all I had for today. Thanks for watching.